The crypto world is seeing retail stablecoin transfers hit a new high. Retail-sized transfers under $250 reached record volumes in August, and total stablecoin retail transfers for the month topped $5.8 billion, driven by activity on chains like BSC and Ethereum as other networks cooled off. What that number tells us immediately is that real people, not just institutions or whale traders, are moving cash-pegged tokens around more than ever, and a large share of those moves are small, everyday transactions. That's important because stablecoins at this scale start to look less like speculative tokens and more like payment rails. You can picture small dollar transfers for peer-to-peer payments, remittances, or in-app purchases being routed via on-chain stablecoins instead of traditional banking rails. The context matters. As wallets and on-ramps get easier to use and as decentralized apps push microtransactions, network effects kick in. The more people use stablecoins for small transfers, the more merchants and services will accept them, and the more liquidity providers will prioritize those networks. But there are trade-offs. Increased retail use raises regulatory eyebrows because authorities worry about AML, KYC gaps, and the potential for illicit flows. It also raises questions about the concentration of stablecoin infrastructure. If most retail traffic concentrates on a few chains and a few issuers, outages, smart contract bugs, or regulatory crackdowns on those issuers could disrupt everyday payments. So the immediate impact is twofold. Positive for adoption narratives. It shows on-chain payments are maturing. And cautionary for regulators and risk managers who must now treat stablecoins as real economic plumbing, not experimental assets. Switching to Bitcoin and macro. Markets recently digested a much weaker than expected U.S. jobs report. Payrolls rose by only about 22,000 in August, far below expectations, and that shock pushed traders to price in a higher likelihood of Federal Reserve rate cuts. Normally, easier Fed policy helps risk assets, yet Bitcoin has been stubbornly capped below roughly the $112,000 level even after those readings moved Fed rate cut odds meaningfully. To unpack that, in theory, lower terminal rates reduce real yields and make alternative stores of value more attractive, which should be constructive for BTC. In practice, markets are more complex. What traders are wrestling with now is whether the jobs miss points to a genuine softening that will sustainably lower yields, or whether it's a one-off noise event inside a still tight labor market. If yields fall and stay down, liquidity could flow into crypto again, but if yields drop only slightly or bounce back as markets reassess, Bitcoin may struggle to break higher. On the technical side, repeated failures to clear a resistance level near 112K to 118K create a zone where buyers get exhausted and short-term momentum traders start leaning the other way. That increases the odds of consolidation or a pullback before any fresh leg higher. Another angle is positioning. Many institutions now hold BTC through ETFs and other regulated products, and their flows are influenced not just by macro, but by regulatory clarity, trading volumes, and risk management signals. So what to watch next? First, Treasury yields and the front end of the curve. If yields slide meaningfully and stay lower, that's a green flag for risk. Second, on-chain indicators like exchange inflows, whale clustering, and ETF flows will show whether money is actually moving into crypto or merely pricing in the potential for easier policy. Finally, watch volatility around major macro announcements. If this jobs miss becomes the new narrative, BTC could re-rate higher. If it's discounted as noise, expect range-bound action. And now to a country-level case study that keeps dividing opinion. El Salvador marked the 4th anniversary of its Bitcoin law with a symbolic purchase of 21 BTC, a move framed by the IAS government as a celebration and as reinforcement of their long-running Bitcoin reserve strategy. The purchase and the Bitcoin Day events come amid ongoing questions about the broader results of the policy. Has the experiment delivered stronger, Investment, financial inclusion, or growth for ordinary Salvadorans, or has it left mixed economic and diplomatic results? The government highlights that the state treasury holds thousands of coins and points to tourism and crypto-related business creation as wins, while critics point to fiscal strain, currency instability risks, and tensions with international lenders. On the symbolic side, 21 BTC echoes the 21 million supply cap and is a headline-friendly way to keep the narrative alive, but the macro reality matters more. El Salvador's relationship with the IMF and international institutions has been strained, and some agreements have included clauses limiting sovereign Bitcoin purchases, which complicates the government's stated strategy of dollar-plus Bitcoin reserves. That's not just political theater. It affects credit lines, bond markets, and the cost of borrowing for the country. From a market perspective, sovereign accumulation of BTC by smaller nations is a novel demand source, but it introduces correlation between national fiscal health and crypto holdings. If a government needs liquidity, selling BTC could become an emergency lever with large market impact. So the broader implication is that when countries use crypto as part of reserves, markets must start pricing in geopolitical and fiscal variables alongside typical supply and demand dynamics. Bringing these threads together, there's a clear pattern. On-chain and macro narratives are converging. Stablecoins are scaling as retail payment rails, real-world sovereign actors are experimenting with crypto in treasuries, and macro conditions, especially central bank expectations, remain the dominant short-term driver of price action. Practically speaking, that convergence means traders and content creators alike must watch multiple layers at once: on-chain flows, retail adoption metrics, institutional allocation behavior, and macroeconomic signals. For example, if retail stablecoin transfers continue to grow, a smoother on-ramp for new users could boost long-term demand for BTC and ETH as entry points, but near-term prices will still be set by liquidity, yields, and headline risk like policy statements or unexpected economic prints. Now let's map this into actionable signals and viewer takeaways you can actually use as someone watching the market. If you're a trader, be disciplined around levels. 112K is a current pivot for BTC, and a sustained break above that zone with low volatility could signal broad-based follow-through. Failure to break it repeatedly warns of consolidation risk. If you're a long-term holder, watch adoption indicators like stablecoin retail activity. Persistent growth there supports the case that crypto networks are gaining utility beyond speculation. If you're watching geopolitics or sovereign allocations, track official statements and IMF or multilateral finance commentary. Those institutional interactions can materially change the risk profile for countries that adopt crypto policies. And for everyone, keep one eye on macro. Jobs data, inflation prints, and Fed language will keep setting the tempo for capital flows into and out of the sector. To spark conversation and gauge the community pulse, consider these open questions. Do retail stablecoin flows signal a permanent shift toward on-chain payments, or are they still ephemeral behavior tied to speculation and tokenized yield? Are sovereign Bitcoin purchases a net positive for adoption, or do they risk entangling monetary policy with volatile asset exposure? And finally, does the latest U.S. jobs data change the long-term macro case for crypto, or is this simply a short-term noise event that traders will quickly price out? Each of those questions invites different answers from different market participants and will shape the debate in comment threads and crypto forums for weeks to come. Now I want to hear from you. Which of these three stories matters most to you and why? Do you think retail stablecoins will replace traditional remittances? Is Bitcoin still primarily a macro hedge, or is it becoming a payments and treasury tool? Drop your take in the comments, be specific, and let's get a real debate going. Finally, if this breakdown helped you make sense of what's moving markets, today hit the like button, subscribe for more concise daily market context, and ring the bell so you don't miss the next update. We'll be watching stablecoin flows, treasury yields, ETF and institutional flows, and any new sovereign moves that could reshape demand. Thanks for listening, and I'll see you in the comments.